Good day everyone, this is Bernadette M. Magaling and I'll be continuing the discussion about capital budgeting techniques. And this time I will be discussing accounting rate of return or the ARR. At the end of this discussion, you are expected to understand the concept of accounting rate of return, calculate it, and assess its usefulness as an investment appraisal method. So before we proceed to the main topic, we will have an outlook of accounting rate of return by identifying words included in it. So first word is accounting, which stands for letter A. As we know, accounting is a service activity with the function to provide quantitative information, primarily financial in nature, about economic entities which are useful in making economic decisions. And just like this, accounting rate of return and other capital budgeting techniques are also intended to provide information which are useful in making economic decisions, especially identifying, analyzing, and selecting investment projects which are consistent to the firm's strategic objectives. So ARR is a rate, which means that we will be able to compute a percentage, which is the percentage of return or profit of a project, which as we know is affected by depreciation and taxes. From this, we can say that accounting rate of return is a capital budgeting technique which measures profitability from the conventional accounting standpoint by relating the required investment, sometimes average investment, to the future annual net income. So unlike any other capital budgeting technique, ARR does not consider cash flows but mainly based on profits. Even though it is simple and is easy to calculate, one of the disadvantages of this is that it does not consider the time value of money or the timing of cash flows, which leads to only to a relative measure rather than absolute measure. So the formula to compute ARR is average profit divided by initial investment times 100, and in the problem, of course, average profit will not be given. So since it is not given, we need to compute it, and to compute average profit, we need to follow this formula, which is cash inflows minus depreciation minus tax divided by number of years. In this, the cash inflows is the total inflows in the whole life of the project. The depreciation is computed by subtracting the cost minus the scrap value, and the tax on the other hand is computed by multiplying the tax rate and the residual between the cash inflows and depreciation. So it is important to note that tax rate is computed in the difference between cash inflows and the depreciation and not on the cash inflows itself. So to better explain, here is an illustration which has the given initial investment of 7,500, estimated life of 15 years, cash inflows per year of 2,000, the depreciation is by straight line and no scrap value, and with a tax rate of 30%. So we are tasked to compute the accounting rate of return. So to solve this, we will just follow the formula mentioned earlier. ARR is equal to average profit divided by initial investment times 100. So to compute first the average profit, we subtract cash inflows minus depreciation minus tax divided by the number of years. So here, the cash inflows will be 30,000, which is computed by multiplying 2,000 times, the 2,000 is the inflow per year, and the 15 years is the life of the project, which is equal to 30,000. The depreciation is by straight line and without scrap value. Since there is no scrap value, we can just put the whole 7,500 here. And the tax, on the other hand, is computed by multiplying 22,500 by 30%, which is the 22,500 is the residual between the 30,000 minus 7,500, which is the cash inflows and the depreciation. When we subtract these three, we will get 15,750, and if we divide it by 15, we will come up with an average profit of 1,050. So next, we will just apply the computed amount in the formula, which is average profit divided by initial investment, which is 1,050 divided by the initial investment of 7,500, which is equal to 0.14. And to get the percentage, we multiply it by 100 and we get 14%. There are times, however, that ARR is computed using the average investment, which is ARR is equal to average profit divided by average investment times 100. So average profit is computed the same with the formula given earlier, which is the cash inflows minus the depreciation minus tax divided by number of years, while average investment is computed by initial investment plus the scrap value, in which scrap value is the value that you would get or you would fetch at the end of the project or the termination of the project. If you add this, you will divide it by 2 and then add any given additional working capital, which sometimes the project is needing funds in between wherein additional working capital will be given in the problem. So you can just add this and you will get the average investment. In here is an illustration wherein we will use the same information earlier with the initial investment of 7,500, estimated life of 15 years, cash inflows per year of 2,000, depreciation by state line, and no scrap value and tax rate of 30%. So now we are tasked to compute the accounting rate of return using average investment. So to compute, here we will just compute the average investment because we already compute the average profit earlier. Average investment is equal to initial investment plus scrap value divided by 2 plus additional working capital. So since there is no scrap value here, the initial investment is just divided by 2 and we get the average investment of 3,750. To apply the computed amounts in the formula, the average profit will be 1,050 computed earlier divided by 3,750, the average investment times 100, which will be equal to 0.28 times 100 is equal to 28%. So we have ARR of 28%. So comparing the two, using initial investment and using average investment, the one using initial investment has 14% and the other has 28%, which we can observe that the ARR using average investment is doubled because we divide the investment by 2. So how can this percentage be used? So this percentage can be used for project appraisal by first determining the target set by the organization, compare the percentage computed, and if the project is higher than the target, accept, otherwise reject. So the companies has a target sometimes, and this may be based on their experience as to what project they accept, what project is preferable for them. So in comparing such percentage, companies must consider the calculation method used because if it is different, example, the target is computed by initial investment, using initial investment, and the actual is computed by average investment, the decision as to accept the project or reject will be affected. So it is important to consider calculation method. Aside from using target, companies usually has the options or project options, 2 or more projects to choose what project is more preferable for them by first determining the accounting rate of return or the ARR of the project or all the project, compare the percentage computed, and accept project with higher ARR. Same with the other, the company needs to consider the calculation method used so that their decision as to accept or reject the project will not be affected. So to explain this, we have here an illustration wherein we have 2 projects to choose as to what project is more preferable, and the given is the initial investment of 100,000, estimated life of 5 years, cash inflows in the first year is 50,000, second year 40,000, third year is 35,000, fourth year is 60,000, and the fifth year and the last year is 80,000. The depreciation is straight line basis with a scrap value of 5,000 and tax rate of 40%. While Project B, we have here Project B with an initial investment of 200,000, estimated life of 7 years. Cash inflows in the first year is 60,000, second year 40,000, third year is 30,000, fourth year is 85,000, fifth year is 40,000, sixth year is 50,000, and seventh year is 30,000. Depreciation is also on straight line basis and no scrap value with a tax rate of 30%. So now we are tasked to compute the accounting rate of return of the two projects and to decide what project is more preferable. So to compute ARR, we have here the formula average profit divided by average investment times 100. So first, we will compute the average profit, and the total cash inflows will be 265,000 computed by adding the cash inflows starting the first year to the fifth year. So the sum will be 265,000, depreciation of 95,000, which is computed by subtracting the 100,000 and the scrap value of 5,000. So we come up with 95,000. And the tax of 68,000, which is computed by first subtracting 265,000 minus 95,000, which is 170,000 times 40%, the tax rate, and we come up with 68,000 tax. And if we subtract this 3, we will come up with 102,000, and if we divide it with 5, we will come up with an average profit of 20,400. After computing the average profit, we will now compute the average investment, wherein we just add the initial investment of 100 and the scrap value of 5,000, 100,000 and scrap value of 5,000, divide it by 2. Since there is no additional working capital, we don't have something to add on, and if we compute 100,000 plus 5,000, we will come up with 105,000, divide it by 2, and we have an average investment of 52,500. So to supply the formula average profit divided by average investment multiplied by 100, we have 22,400. The average profit 50,000 divided by 50,500, the average investment, and if we divide this, we will get 0.3886 times 100 is equal to 38.86% ARR. To solve for project B, we first compute again the cash inflows, wherein it is the sum of from the first year to the seventh year, which is equal to 335,000. Then the depreciation will be 200,000 since we don't have scrap value, and the tax is 40,500 computed by multiplying the difference between 335,000 and 200,000 of 135,000 times 30% is equal to 40,500, and we divide it by the number of years, which is 7, and we will get 94,500 divided by 7 is equal to 13,500 average profit. To compute for average investment, on the other hand, we will just need to divide the initial investment of 200,000 since we don't have scrap value by 2, and we will get an average investment of 100,000. So to compute for ARR, we have 13,500 average profit divided by the average investment of 100,000, which is 0.1350 times 100, which is 13.50%. So project A has 38.86% and project B has 13.50% ARR. So our decision will be the company should choose project A because it has higher rate of return compared to project B. So in summary, accounting rate of return or ARR is based on profit. Since it is based on profit, it can be affected by non-cash items such as depreciation and tax. So in computing ARR, we have two formulas. First is average profit divided by initial investment times 100. While the second is average profit divided by average investment times 100. So here, average profit is computed cash inflows minus depreciation minus tax divided by the number of years, which is the estimated life of the project. So average investment, on the other hand, is computed by initial investment plus scrap value divided by 2, and adding any given additional working capital. So in accounting rate of return or ARR, the decision rule is to accept project with a higher rate of return. So that's all. I hope you learned something. Keep safe and thank you for listening.